All right, so overall, a pretty good day, I'd say, for the Bears, but no surprise. Whenever you get a channel, I know it's frustrating, and it frustrates me too, but it just is what it is. Whenever you get a tight channel and a lot of overlapping bars, and the odds are whatever soft you get is going to become a trading range. And the other frustrating thing about it is you got to understand the higher time frame context, consecutive bull bars, doji. The odds are there's going to be more buyers in this general location than sellers. And because of that, it's really not ideal of an environment whenever you see this continued selling. The odds are, it sounds crazy, but you're going to have traders buying and just scaling in, especially institutions. If they can trade small and use large accounts and scale in, they will do that. And knowing that the higher time frame is in a trading range, and the net effect of that is this: you end up getting basically a leg in a trading range that evolves into a large trading range. Coming into today, we had a gap up on the open, and first part of the day, bar one, it's relatively big bull bar closing on its high. It's a strong enough bar that the odds favor at least a second leg. And therefore, it's an okay bar to buy, but the risk is relatively big in that because of that, lowers the probability for the bulls. It makes it a more dangerous environment for traders. 1 and 2 consecutive bull bars that increase the odds of buyers blowing at least second leg up. And then 3, now we have 3 consecutive bull bars. Tail above 2, tail above 3. Probably first reversal down is going to be minor. And then 4, now we have 4 consecutive bull bars. That makes me think that it's good for the bulls. Probably going to pull back soon. But what do you notice about the bars? We have a big bar 1, small bar 2, tail on 3, tail on 4. It's a trend from the open, but with it being a possible failed breakout of yesterday's doji, there might be more traders selling up here rather than buying. Then we have another doji on 5. Looks like we're going to pull back. 6, high one buy, good for the bulls. You take the buy for a swing or for a scalp. Well, it's pretty late, and I think if you're buying it, you probably have to buy it for a swing, and if you get a bear bar, you can always get out. But you're buying, hoping that the small pullback rally continues, knowing that the odds are against it. Doji 7, probably buyers blowing at least second leg up, and then we got 8, a bear bar. For the bears, consecutive, it's a bear bar closing on its low. 8, do you get out of longs below the bar? Some might. I still think probably buyers below. Then we went outside up on 9. Outside up, good for the bulls. Double top with 5. But it's a good bull bar, but it's a bad context bar. Outside bar, late in a trading range, basically an expanding triangle with 5, 6, and 9, and then 7 and 9. That's a dangerous location for traders to be buying. And then we have an inside bar, 10, not a great sell below the bar, probably buyers below, but triangle, inside bar, basically breakout mode. You can see what happened. We had a close on 11, closing below 10 and below 9. Good for the bears. Makes me think the odds are we're going to go lower. 11 and 12 consecutive bear bars. That increases the odds of whatever reversal up we get is going to be minor. 13, bull bar, but tail above the bar. Probably sellers in the upper third of 13. And that makes me think because of 11 and 12, we're probably going to fall below the 13 low and go lower, and we'll probably fall below 1. Then we tested up on 14. Now we have a micro double top, 13 and 14. Not a great sell, not a great buy above. If I had to pick a direction, I'd probably be short, betting on a second leg down. Then we got the surprise, 15, but because of the dojis, 13 and 14. And the tail on 15, probably bad follow through, and we may end up getting a bounce. 16, bull bar, testing the breakout point. 14, probably sellers above and a second leg down. 18, outside down, good for the bears. Probably going to go at least a little bit lower. And then we got 19, bull bar closing on its high. What about buying it? You can argue it's parabolic wedge, 12, 15, 19. Whenever you get a parabolic wedge and it's basically part of a micro channel like it is here, and it's a really dangerous environment, it's a breakout on a higher time frame, and look where you are. You're right below the moving average. It's reasonable to think you may get a rally and at least a couple of legs up, but a parabolic wedge in the form of a micro channel usually leads to limited upside. And you can see what happened. Instead of finding buyers, we immediately found sellers, went outside down. 19, a surprise, increased the risk that we go at least a little bit lower. And then 20, follow through selling, good for the bears, but tail above the bar, bad for the bears. And then we have a bull bar on 21, 19 and 20 consecutive bear bars that increase the odds of sellers above in some kind of second leg down. 22 bear bar closing on its low. We may go a little bit lower, but I suspect we're probably not going to go that much lower. And then 23 bull bar closing on its high. Good for the bulls. Now we have another wedge bottom. Is this the start of a wedge bottom that's going to lead to a strong reversal up? It's always possible, but 23 or 22 in this case, 23 forcing you to buy in the upper third of 22 with a fairly tight channel. Stop order bulls not making money. That lowers the probability for the bulls, increase the odds that the upside is probably going to be limited. 24 bear bar closing on its low. I suspect that we're probably not going that much lower. And then low one short 24, second leg up 25. Good for the bulls, but as far as buying it, you're buying really close to the moving average and the channel's fairly tight. And then weak follow through 26. It's not what you want to see. You don't want to see a rally testing the moving average and then stalling. 27 reversal down closing on its low. That's a strong enough bear bar that the odds are we're going to go at least strong enough surprise that we're probably going to go at least a little bit lower. And we got follow through 27, 28 trapping the bulls who bought on above 23, who bought above 25, who bought below 26, betting with a bad low too. And the bears who sold below 24, scaling in at the moving average, making money. 27, 28, probably going to go at least a little bit lower. 29, doji, not a great sell above the bar, but it's not a great stop order buy. And then we got a doji on 30, but probably sellers above. 31, we have a doji overlapping bar. Looks like we're going to go at least a little bit lower, but I suspect we may go a little bit lower, but I suspect probably buyers, and we probably have to test the moving average first. And then we have a bear bar closing on its low, but not ideal. The channel is tight. Probably going to try and reverse up soon. And then we try to get a bull bar on 33. What about buying above it? You can. Yeah, I think it's better to wait for more buying pressure and some kind of more clear double bottom. Now for the bears, I think it's reasonable to get out above a bull bar. We'll probably test the moving average fairly soon. Then we failed to go above 23 and we formed a bear bar closing on its low. So the bulls who bought the close at 33, trapped on 34. Then we broached it down inside 35. Consecutive bear bars, 34, 35. Good for the bears. First reversal up, probably going to be minor. Then we got a doji, 36. Increase the risk of sellers above, and we may go at least a little bit lower. 37, bear bar closing on its low. Getting climactic, so probably downside, probably limited. We still can fall to 7,500. And the bulls, they have yet to have a strong buy signal bar. And that's problematic for the bulls. 32, doji. How much lower can we go? We can go a little bit lower, and we can easily fall 10 points below 7,500. We keep alternating bull bars and bear bars, and that makes me think that the downside risk is likely limited. 39, bull bar closing on its high. You get out of longs below that. Should you get out of shorts below the bar? I probably would, even though it's a parabolic wedge with open gaps, so it's dangerous to buy, and it's a little bit dangerous to sell. And if you're a bear and you sold below 27, you did not get out above 33, you probably will get out above 39. And you can see what happened. We formed a bear bar on 40. And it's interesting. We came within 41 came within one tick of 39, but failed to go above it. So theoretically, bears who are short above 39, they're still short, hoping that we sell off. Bear breakout 42, good for the bears, probably going to go at least a little bit lower. But realistically, would I sell this? I think it's dangerous. You're right at support. And because it's a bear bar, if we get a bull bar closing on its high, I think traders get out. So if we get something like 18 or 23 within the range of 42, I think it's worth getting out of shorts. And instead we broach the downside. But 43, now we have a sell climax, bear break out of a bear channel. And the odds are we're probably not going to go that much lower. And then we got a bull bar on 44. I think bears probably get out above the bar. Bulls can buy. Doji 45, not great for the bulls, but at least it follows through bar. We had a low one short 46, probably buyers below. And then we had a doji 47. That increased the risk that whatever reversal up we get is going to be minor. I still think the bears should sell 44 or sell 46, with 46 and 47 being a reversal and a doji, and 47 being a small entry bar after the low one. Probably sellers not far above 48, bull bar. And then we tested the high of 46, found sellers in upper third and reversed down. Low 249. I think it's a bad low too. And then increased the risk of buyers around the 49 low and the low of the day. 50 bear bar, but testing the low of 44. Probably buyers around this area. Then we got a bull bar 51. Good for the bulls. Makes me think we're probably going to go a little bit higher. And you can see what happened. We got a second leg down 52, but probably buyers below 51. Bull bar 53, but now we have overlapping bars. Lowers the probability for the bulls. Signal bars are small, so if you buy above 53 and you put a stop below 52, you might get stopped out in 54 bear bar. But now we have alternating bars. Basically a small nested wedge. We sold off on 50 and 51, rallied on 51, sold off 52, rallied 53, sold off 54, and we rallied 55. So it's a nested wedge inside of a larger wedge. Strong follow through bar after 56, good for the bulls. For 55, follow through 56, good for the bulls. Second leg up likely, but first trend line break, and then increase the risk that we go sideways. 57 bear bar, probably buyers below and at least a second leg up. And then we got a high one buy on 59, good for the bulls. Probably gonna go a little bit higher. And then we got 3 consecutive bull bars, 59, 60, 61. I suspect probably buyers below and at least a bounce. And then we started to get a series of bars, but they were small, and that increased the risk that we were going to pull back. 64, first reversal down below 63 was bought. Now we have a breakout pullback buy. It's basically a high one buy. We sold off 64, rallied 64. That increased the risk there might be sellers not far above. And then we got the bear reversal bar closing on its low. Now we have a wedge top, 57, 63, and 65. I would definitely get out of longs below that bar. Then we got the doji on 66. Probably sellers above the bar. And you can see what happened. We broke strongly to the downside, 67. 67, 50%, 50% pullback from the low of 54 to the high of 65. We may just go sideways here. Reversal up 68, sellers above. And then we tried to basically form a double bottom. And then 72, bull bar. I would definitely get out of shorts. Bulls can buy, but probably limited upside. And you can see what happened. We've rallied to the end of the session. Stop orders. Reasonable to buy above 1 or 2. If you do, you probably get out below. Maybe you get out below 8. You definitely get out below 11. And then bears, if they sell, where do they get out? They probably get out above 18. But if they do, they sell again below 19. And if they get out, they get out below 23. And if they do, they probably sell again below. If they're really quick, they sell below 26, better 27. Then if you sell below 27, you can get out below 33, but it never triggered. Same with 39, never triggered. Then you get out somewhere down here. And then if you're really aggressive, you sell again below 49. I think that's really tough to do. Bears, if they're short, I'd get out above any of these bull bars, which means you're getting out above 55. Bulls can buy. You don't have to get out below 57. I think it's okay. And if they do, they buy again above 59. And they get out below 65 if they're still short. I think it's worth getting out below 63. Bears, if they sell below 65, they probably just get out somewhere in here. Certainly as 72 starts to reverse up. Limit orders, I thought probably sellers above 7 and sellers above 13, but it never triggered. I thought buyers below 15. I thought buyers below 16 for a bounce. The sellers not far above. And then, probably arguably sellers above, but tough to take those trades. And then through here, I'd rather look to buy certainly below 44, 51, 52, any of these bars for a bounce. Then I thought sellers up here betting on a test at 57, and that's what happened. Buy the close, sell the close, probably buy the close 3 and 4 for at least a bounce. Sell the close bar 12. Probably okay for at least small second leg down. And then this is not great. Sell the close. That's a channel. You're better off selling pullbacks. Let me take a look at questions. 15 and 30-minute or 60-minute chart evaluation setup. Oh, I see. I don't know if we're talking about, I guess we're talking about the wedge 1, 2, 3. I mean, you can call it a wedge. I mean, it's certainly valid, or 1, 2, 3. It's kind of, I think about like an expanding triangle. So it's just range, it's just volatility expansion. You can look at it like that if you want. 15-minute chart, 30-minute chart, 60-minute chart. It's all the same pattern. I think the most important thing to understand is on the Globex chart. It's a day only chart, but let me go to the day only. I think the most important thing to understand is, there you go, same pattern right there. But overall, we have a very strong, we have a fairly tight pull channel, and that increased the risk of buyers on pullbacks. And so far, that's what we're getting. Once that buy starting to get a small reversal at 1245, somewhere in here, or do we have to wait and see the bears get trapped as well? But yeah, that's the problem with reversals in a small pullback bear trend. By the time you get the reversal, it's usually limited, and bears who sold and scaled in, look what happened. They were able to avoid a loss. That's pretty common. And usually, when you get a reversal in a bear trend, small pullback bear trend, it's usually not all that certain. And then when you get the bear reversal, it's usually too late to end up buying. When you get the reversal up, you're not all that certain. And by the time it becomes clear, the upside's limited and you reverse into a trading range. So where do we go? I think tomorrow's a halt. Tomorrow's the early close, but I think sometime over the next couple of weeks, we're probably going to find buyers and reverse up and test somewhere up here. June 15th high, or even the all-time high at around June the 1st, but we'll see. All right. Thanks, everybody. And I hope everyone has a great holiday for July 4th. Those of you in the U.S., and I will talk to everybody next week.